Steve Reitmeister is the CEO of the StockNews network, bringing 40 years of experience to help individual investors find outperformance. For the better part of the past 2 decades, he was the editor-in-chief of Zacks.com, where millions of investors enjoyed his timely market insights. His commentary has also been featured on other leading investment websites, including Yahoo Finance, Seeking Alpha, CNN Money, and MarketWatch. Steve has an MBA from DePaul University and a BA in economics from the University of Wisconsin. Go Badgers! Steve is also the editor of the Reitmeister Total Return Portfolio Service. This is where he puts his 40 years of experience to work for you in selecting the best trades from the current environment. Okay, Steve, you know how the game is played here.
Sure.
You have until 5 minutes before the hour. And then we will be awarding our next batch of 33,000 in prizes today. And if anybody has any questions for Steve, they can just put them in the chat box on the right, and he will get to them, at his opportunity. Okay, Steve, I'm going to mute myself. You have the floor.
Yeah, thanks so much, John. The name of my presentation today is Revised 2022 Stock Market Outlook, because the way we were coming into this year, the way we were all looking at it in December and January, when it just seemed the bull market was going to continue on and stocks made new highs about 4,800. Quite a different world we're at today. And I don't want to give like a total spoiler alert because I think we're going to cover a lot of good ground today. But in general, what John said earlier about what he thinks is the downside potential in this market, I'm pretty well agreed on that. I just don't think we have the makings of a bear market, but what we do have is the makings of a ripe correction that was overdue to take some profits off the table. Some scary news out there with Russia inflation. That's plenty good reason to get out. But we're going to talk about why the reasons that really we just shouldn't go any further, and why there should be a bounce, why we haven't seen the highs yet, and how we take it from here. So that's what we're going to talk about in my session today. So he already told you a bit about me. If you recognize my name, probably from all the years at Zacks.com. But I'm just going to go down to the last bullet there. Mission is to help investors beat the market, meaning the reason why I put out my own shingle to have my own company is I just wanted to do things my own way. There's a lot of folks, let's call it the investment media, where their sole goal is to give you headlines that are enticing to get you to click and so they can sell ads. But that's not quality advice. That's not strategies that you can use to outperform the market. So I wanted to have my own company where I could focus on that. And that's what I do on StockNews.com. So if you haven't been there, check it out. The agenda for today, we're going to go over a basic market outlook, obviously with a focus on Russia and Ukraine and what that means to the market. So with that landscape, what is the trading plan to outperform? There's always some strategy that will work, even if I felt it was a bear market. Right, which I don't, right? But even if it's a bear market, there are strategies to outperform, and that's basically selling all your stocks and shorting the market with 2 fists, right? But we'll talk about what I think is the plan from this moment on and how to chart our course to outperformance the rest of the year. Along with that, I'm going to talk about the 100 best stocks for the year ahead and how exactly we got to that, right? Which is a kind of a computer-based model that we've constructed over here that I think you're going to be very pleased with. You're going to kind of enjoy what we put out here because there's really something for every investor and every market environment, different strategies, different strokes for different folks to come up with those 100 best stocks. And then, of course, Q&A. All right. So market outlook. Bull market till proven otherwise, right? And I got to explain why this is the starting premise. I have an economics background, and when you understand that the economy is kind of like a helium balloon, right? Its natural propensity is to go up. The stock market's natural propensity is to go up. So therefore, to really create a bear market environment, to really create a recession, that usually leads to that, you need a stronger opposing force. You really need to hold down aspect of the market. So don't get fooled by one tricky headline here or there. Oh, there's a death cross coming, or one economic report. It takes a lot of negative weight to push the market down, okay? And so we have to start with the premise that's a bull market till proven otherwise. And if that doesn't work for you, then how about the fact that 85, 90% of the time in human history, it's been a bull market, right? So we have to start with that premise. And in order to get bearish, we need to have like a preponderance of the evidence that's really that bad. So bull market till proven otherwise. But in the interim, the market hates uncertainty, and you can think about that right now. There's tons of uncertainty. We'll kind of go through a menu of that here in a second. So that uncertainty, even in a bullish, primary bullish market environment, it's kind of sell first, ask questions later is the mentality. That's what leads to initial pullback, and then people see what happens and they sell more if they're still fairly uncertain. But if they are feeling more comfortable with things, then the market starts to return, right? As the certainty returns, the bull returns. All right. So what are the reasons for uncertainty? Well, going back a few months, it almost feels connected with what we're doing here is the Omicron virus. It did absolutely lead to a tremendous surge in cases, but gladly, not very deadly, didn't really change the economic outlook for the country, and we were able to just get on with things. And so that issue's been asked and answered, but that kind of started this uncertainty party. Inflation, okay, well, it's still lingering out there, and that is bothersome because of how it affects consumers, how it affects the fact that in the stock market, we see that a lot of bear markets have been brought on by raging inflation, right? So there's good reason to believe there's some part of this inflation that is transitory, but there's other parts that aren't, right? So that's still definitely lingering out there. And of course, the uncertainty du jour is the Russian-Ukraine situation. And so we're going to spend a little bit more time on that one. All right. The military conflict pattern, right? And I probably should have grabbed the chart, but it's just so common that and if I tell it to you, you're going to be like, oh yeah, this makes sense. This is what's happened. The number of times we've been in military conflicts in our lifetimes. There's an immediate sell-off because of the uncertainty, right? The shock of war. Oh my goodness, is the United States going to be dragged in? Blah blah blah. All those kind of things, right? So that's what sell first, ask questions later. Great. And then the bull reemerges at some point, 1 to 3 months later because of one or two reasons. If indeed we are going to be in a military conflict, war equals increased government spending is actually positive for GDP. Now, I don't think anyone out there wants to go to war just to improve the economy, but this is part of the natural consequence. And it's not necessarily an either or, it's sometimes it's both these things. Realize there's no real disruption to the economy, in particular, if the military conflict is not on our soil, which it hasn't been since the Civil War, I think, in the 1850s. So the combination of these two is that people are like, oh, I guess it's not so bad, and they get back into buying stocks because there's no reason for them to head lower. So now the dangerous question, is this time different? And I think we all know as investors, that's one of the most dangerous questions because we shouldn't think that it's different. This is where we talk ourselves out of things. But when we start to review what's going on with the Russia-Ukraine situation, we will appreciate this is not Iraq. This is not Grenada, right? This is not some minor military, Iraq was not a minor military conflict, but it was a much smaller adversary. Even Iraq and Afghanistan together are probably half or 2/3 less of the military might of Russia, right? And what it means for those things. So Russia, much larger population and military. The question is, if Europe gets dragged in, does the United States get dragged in? Or if NATO comes in, what's the US's involvement, things of that nature. So far, we've stayed on the outside of it, but what happens next, who knows, right? On top of that, you have the concern that Russia has government-sponsored hackers. I'm sorry, that's pretty damn obvious. And so the idea of cyber warfare as opposed to direct military conflict. Imagine that some main websites in the United States start to have problems. Imagine if Amazon started to have problems, and Google, and some of these others, it would be pretty headline worthy. It would rattle some cages, no doubt. All right, so yes, this is a bigger deal, no doubt about it, but likely still the same outcome. So maybe it takes a little bit longer for us to appreciate that it's not really going to drag down the economy, but in general, this really shouldn't be a reason for an extent, for really tipping over into bear market territory. All right, so the trading plan, as I see it at this very moment, uncertainty is still pretty darn high, right? So the next real support level is 4,000, for which I expected there to be a big bounce. But I have to admit, and this is what what John was saying, and here he and I did not have a conversation beforehand, just two guys coming to the same place. This market, in particular because of all the computer-based traders, they just love to push things to their technical limit, right? So the idea of a 20% correction, because beyond 20% is a bear market territory, to push things that level just to scare the bejesus out of everybody, even if it's just an intraday move, which I totally agree, we could totally drop down there and then rally 5% into the close, right? That would not be crazy in today's modern market. But I think somewhere between 4,000, which might end up being plenty of support, or 38.54 would be a correction, right? So no current reason to believe there's going to be a bear market to go further, right? And I'm going to spend a little bit more time on that here in a second, because there's another really good reason why there's a floor under the stock market. But let me say that we don't have to make it down to 4,000. We don't have to make it down to 38.54. The fact that oil prices are tumbling at this moment relieves a lot of the inflationary pressures that were getting people worried. And it is possible that we start to bounce now. So what I don't want is people to see this. Okay, well, I'll just get out of the market, or I'll get short until 4,000 and then magically get back in when they ring a bell at 4,000, and I can get back in the market. I'm saying, I think we get to 4,000. I still am primarily long the market. I just have a little bit of cash off the tail, and then I'm going to buy a little bit into that bounce. I'm going to get more long into that bounce. Do not make it a binary decision. Do not be all out of the market, because who says we're ever going to get there? Okay. Looking out a little bit further, 1 to 3 months, I wanted to show you guys this chart, which is kind of like, everyone who's kind of in panic mode, everyone is like, this market's scaring me. And yeah, I kind of get why it's scary. Let's take a look at this kind of, last 10, 12 years, all the times there's been scary little events, right? And I think you can kind of see it. So why even shout them all out, okay? All the times there's been debt crisis, potential military conflicts, issues with China, this, that, the other, all these things that ended up being buying opportunities, right? The scariest of which, of course, was the coronavirus, which indeed was a shock to the system, shock to the economy, and good reason for a sell-off. But even there too, you got the shortest bear market in history, at like 3 weeks, and then bounced, which is actually a pretty good segue to why I'm still bullish this time. Is, remember, the market climbs a wall of worry. Be greedy when others are fearful. Buy low, sell high, right? So this classic investor wisdom that should come to the fore, right? These are reasons to keep a bullish bias. In particular, right? Because there sometimes is reasons to believe that things will get worse and worse and worse, and the market will go down and down and down. The average bear market is a 34% decline. In 2008, we had like a 46% decline. So there are times to not just buy the dip right away. There are times to get short. But when I talk about this next one, especially because of Tina, meaning the reason to be bullish, not just because of these, time-honored sayings of, market climbs a wall of worry, because of Tina, it still is very much a bull market environment. There is a floor into the market, right? So what is Tina? Probably most of you guys know there is no alternative to owning stocks, okay? What makes it a Tina environment? Low interest rates. So yes, interest rates are coming up. The 10-year treasury is at 2.1%. But guess what? The long-term average is 4%. We are still incredibly low, which makes stocks a better investment because you put your money in cash, you put your money in a checking or savings account. As you know, you're probably just recently did your taxes, you got like no interest on your cash, right? So it's still low rate environment, cash is trash. Bonds are unattractive because if there is inflation, if the trend is that rates will be going higher, bond rates will go higher, bond values will go down. So the idea of buying bonds this time is one of the stupidest decisions on the planet, right? So if cash is trash and bonds are unattractive, the stock market offers the best value. Easy to say, let's prove it. Okay, now this is from Yardeni Research. Unfortunately, he didn't update it as the beginning of March, but you'll still get the general idea. What we have here is the red line is the earnings yield of the stock market. The earnings yield is essentially the PE flipped on its head. If you took the earnings per share of the S&P 500 and divided it by the price level, that would be generally the yield, which is like what you would get paid back by the stock market. And that's right now just a little over 5%. So yeah, the 10-year treasury on this chart, it's 1.93, but yeah, right now it's like 2.05 or 2.1, okay? The idea is that if we go back in history, these two dance together, right? Because they're kind of like, these are the trade-offs. Should I be in stocks or should I be in bonds? Well, if the earnings yield is higher on stocks, the money will go in that direction. If the earnings yield is higher in bonds, the money will go in that direction. Parity broke here because bond rates kept going lower and lower, and particularly during the Bernanke days when the Great Recession came, and he's just crushed rates as the way in which to have the economy rebound, which, by the way, did lead to the longest recovery in modern history until the coronavirus had a little detour for us, right? But I think you can see here that stocks are the infinitely better value, right? So here's a really cool chart that makes it even easier to appreciate. So here you see the relationship between those two. This red line, okay, so the blue line is where the stock market is currently at. It says 4436 because it's as of the end of February, but we're really at 4200. The fair market value of the S&P 500, if it was being valued like the bond market, right? If they were back in parity, would be 11,700. Am I saying that the stock market really should be 11,700 right now? And the answer is absolutely no, because rates will continue to go up. What I'm saying is, and going back to this previous slide, I think these two in the next 18 to 24 months will meet up here between 3.5% to 4%. That's when it's going to be time to ring the bell and start getting more worried about valuations, about the market heading lower. But until these two get closer together, it is just hard to be bullish. Here again, TINA environments. There is no alternative to owning stocks because cash is trash and bonds are basically trash with rates going higher. Okay. So because of TINA, right? Because of TINA, just go back to March of 2020. Was the coronavirus over, right? Was the economy rebounding? No, we were in absolute outright free fall. In fact, Q2, April through June of 2020, the economy contracted by over 30%. The worst quarter during the Great Recession was a minus 8 or 9% for GDP. So no, it didn't bounce because of the economy was about to improve, because it sure as hell wasn't. It bounced because of TINA. Okay, and that's why there really is a floor under the stock market right now. So you need some stronger force to work its way through this to really say why we should be pressing lower than we are now. So what we need to do is we need to be expecting a bounce, which could happen at any time, right? And we need to line up the best stocks for that bounce. And that's where we're going to segue to kind of the second half of our conversation here, the 100 best stocks for 2020. What makes them the best? Okay, so I talked about in the intro, this being a computer-based model, right? And I'm going to give the full story, but I just want to quickly show you why, like, do I have your attention? I want to show you there's 10 different strategies. I want to show you the all-time returns and the returns in 2021, okay? 10 different strategies, 10 stocks each. That's how we get to 100 stocks. Something for everybody. Growth, stocks are 10, small caps, value, safest, technology, stocks to short. Yeah, stocks to short, right? Income, large caps, momentum, something for every market environment, something for everyone's investing temperament. The 10 top stocks in each of these categories. The all-time average annual return is here. I should have put up the S&P 500. It was 7.98% in this time period. So everything's beating it. Okay. I'm getting texts that are appearing on my screen. Isn't that great? And here's the returns for this year, right? In a few slides, I'm going to talk about how's it doing in 2022, because I guess you're saying to yourself, hey, well, that's in a bullish environment. How's it doing now? I think you're going to be very impressed with its results in 2022 as well. All right, so this is why you want to pay attention. These are the 100 best stocks revealed. So let's just quickly go over an agenda of how we're going to talk about this. These are black box strategies. What the heck is that, right? 10 proven strategies, 10 stocks each. That's how we get to 100. I'm going to talk about 2 ways to trade these successfully. Here again, not every investor is the same. How do you trade successfully? Then determining which strategy is right for you. And then, yeah, how do we see these stocks now? And then we'll finally get into the Q&A portion of today's discussion. Okay. Black box strategy. Probably just like Tina, half you guys know what this is, half of you maybe are unsure. A computer-driven trading model where you do not know the parameters. Okay. So a lot of time, you know what stock screening is, and they're like, okay, I got a market cap over $1 billion and a price over 25 and a PE of this and a growth rate of that, blah, 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 all these different things. That strategy, you know what's in there. That is not a black box. A black box strategy is where you do not know the parameters, okay? So computer-based model, right? Computer-based strategy where you do not know the parameters. So why is that attractive? Why is that of interest? Well, first, because computer-driven models leads to a more disciplined approach. This is why over 50% of the trading on the market these days is computer-driven, right? Getting rid of emotions, getting rid of the fear and greed that even professional investors can succumb to. But you hide the parameters when the performance is high. Why? Because the more people trading it equals less effective. If you create a strategy like the 10 strategies we have with performance that is anywhere between 2 to 10 times better than the S&P 500 and consistently to be in the market, the last thing you want to do is to give it to everybody, right? Give them the parameters and then have a fire hose worth of attention brought to that by the Citadels and Goldman Sachs's of the world, okay? You need to keep it private so that less people are trading it so it remains effective, right? The funny thing is I could flip this on its head and say, by the way, any strategy that anyone has ever told you and gave you all the parameters is probably worthless. That's the sad fact, because if it was any good, they would absolutely go the black box strategy approach, because they wouldn't want people to be easily be able to mimic it, to be able to reap the rewards, right? So you do black box when you have confidence that the picks are profitable. Okay, so why am I confident that picks are profitable besides just showing you the performance numbers on the page? So let me give you a little bit of the background story, how we got there, and I think you'll appreciate the verity, the totality of this story and why it makes such sound investing sense, that it works. Okay, so let's roll back. January 2021 on StockNews, we launched the Power Ratings system. Okay, this was a model. They're putting the text. I think you see it coming on the screen. They're putting out the credit card number. So hopefully everyone got that, can order some concert tickets. I just don't know how to turn it off. It's like on my computer. So I'll just try and X those things out as fast as they come up. So yeah, the power rating system, we came out with this just a shade over a year ago. This was a quantitative model taking a look at 5,300 stocks, okay? The reason to do it is the performance, right? So the performance of this model, going back to the beginning of 1999, and this is through the end of 2021, this model when the S&P 500 did an average of just a shade under 8%, the A-rated, top-rated stocks did 31%, nearly 4 times better. Even the B-rated stocks, which are, so the A's are the strong buys, these are just the buys. This is 2.5 times better, right? And then the big middle, right, the C-rated stocks. But look at this. Sometimes the way to outperformance is getting rid of the garbage in your portfolio. These stocks underperform even in a bullish environment, the F-rated stocks, right? So the performance there, so clearly something taking place here that each step up the journey, right? So the folks, the worst ratings really stink and destroy your portfolio. And each step that you work up, you see the verity, the reason, the purpose in which to have higher and higher ratings, in which to attain higher performance. Okay, so this is great. The con, right? So the pro is the performance. The con is there's 1,300 buy-rated stocks in any day. The top 5% are A-rated. The next 20% are B-rated, right? So the top 25% of all the stocks we're rating are buy-rated. This is too many stocks to research effectively, even for a guy like me who does this for a living, right? So, and then you have the idea of which stocks are the best for different types of investors, right? We have growth folks, we have value, income, momentum, right? We have and everything in between, right? Aggressive and conservative, right? Fundamental and technical. So we want things that are for different types of investors. So we went back to the data scientists who created the power rating system and said, okay, we have a new project for you. We want to create 10 strategies, here again, something for every investor, and each one of them has the perfect number of stocks, right? The idea of top 10 stocks in each strategy, 10 stocks each, right? And of course, let's increase performance. So narrowing down the number of stocks, that's great, but if it doesn't increase performance, then kind of what's the point? So, and this is what led to this. All right, so what makes them the best? We already showed you this. So the thing is, absolutely, positively, he dialed in. So each of these strategies, 10 stocks each, dialed into the best of the parameters that are in the power rating system to find the best stocks in each category. So now let's talk about how to put this into action. 2 ways to trade, right? So I'm going to highlight the 2 of them and then go into a little more depth. The first method is the more the stocks, the merrier, right? And that will make sense here in a second. And the other is, if you don't want to be chained to your computer, you don't want to have 8 computer screens and jacked up on Red Bull all day, and you prefer to go golfing or fishing or spend time with your family and then just kind of dial in and more easily make profits, that's the second approach. So let's talk about each. And then, in the category of know thyself, I think when you see these spelled out, you'll know which strategy, which method of which to employ these stocks is right for you. The more stocks, the merrier. The investor who loves researching stocks, no such thing as information overload, meaning like just bring it on, right? Just give me as many ideas as you can. They're going to go through the additional steps, whether that's looking at chart patterns, whether that's looking at additional fundamental research, whatever that is, reading the news, reading the earnings report. They just want as many great ideas as possible, and then they will boil that down to the ones that end up in the portfolio. So for these folks, it's real simple. Those 10 strategies are updated every single day, right? The 100 best stocks are there every single day. And no, they're probably not going to check out all 100. They're not going to check out all the strategies, but maybe there's 3 or 4 that they're really dialed into, and they're going to check those out and research them every time a new pick comes up, right? Frequently comes to site for fresh ideas. That's one approach, which is going to lead to a lot more time invested. But if you dig it, if you love it, why not do that? Now, on the flip side, the 10 minutes a month approach, right? Simplify to get rid of TMI, to get rid of the too much information, right? Oh, I got 10 strategies. What do I do? So let's say you pick a strategy, right? And we're going to talk about that in the next couple of slides. How do you narrow down the strategies that make the most sense for you? So let's say you've gone through that. You've picked out a strategy. You buy all 10 stocks equally weighted, right? So whatever amount of money you want to put into that, 10,000, 50,000, $1 million, whatever that is, then you buy 10% allocations to each. Real simple. And then you rinse and repeat 4 weeks later, meaning you literally do not look at those stocks again for 4 weeks and you come back later. Okay. So the why not more often is, yeah, you could, but I think you're just going to lead to more work and less results. And let me be very clear here. The performance study that you saw that showed the outperformance of these strategies was based upon a 4-week rebalancing. Yes, I took a look at a 2-week rebalancing. I took a look at 1-week rebalancing. There was a little bit more performance, but I felt it was dishonest. Who wants to rebalance a portfolio every week? Let's make it a monthly process. The performance is plenty good. Okay, so that's why it only needs to be done monthly. And by the way, it does match up with the performance we have. So I'm not trying to give you a strategy that's going to lead to lesser performance. The performance numbers you saw was based upon the same method of a 4-week rebalance. However, I do recommend that folks go for 2 strategies. Why? The strategy that you may love the most, for whatever reason, who says it's going to work? The market is constantly going through sector rotations. There's constantly a movement of money to what's hot and what's not. I like the idea of not 2 complementary or 2 similar things. I like 2 different strategies, something to balance out the other. So maybe if you have an aggressive one, go for a conservative one. Or maybe if you took the growth strategy, maybe you take the value strategy, right? Something to balance it out. But here again, we're talking a couple slides here, or we'll talk in the next set of slides here, how you select those strategies. But I do recommend 2 strategies. And by the way, in the idea of putting your money where your mouth is, I am doing that myself. I started this actually last February when I first got access to these strategies. I'm going with the value strategy because historically I'm a value investor. And then I went for something much more aggressive. I went for the small cap strategy in my Roth IRA account. And I'm glad to say that I have handily beat the market in that time. And yes, if I had any brains, I would have showed you my Schwab trading account to show you the gains. But if I'm remembering correctly, and I'm pretty good numbers, I believe the account started at 223,000. I'm not saying that to brag, just I'm 55 years old. My Roth's going to have some money in it. And I looked at the other day, it was like 305. Okay, as you know from last February, and it was like the end of February towards where we are right now, the market's not up that much. Boy, people are really texting up a storm today. All right, so yeah, which strategy is right for you? So first, we're going to talk about trying to find the strategy that's most aligned with your investing style. Then we're going to talk about the bullishness rating that we've created to help you dial in strategies based upon your market outlook. And then just simply the idea of, hey, just show me the top performing strategies. I'm just going to go for that, right? So any of these methods is going to work for you. But I'm a strong believer in know thyself, to go for the strategies that are just most aligned with who you are as a person and what you've always believed in, right? So you got the 4 basic flavors. This is the chocolate, vanilla, strawberry, and mint chip of the investing world. Growth, value, income, momentum. We have strategies for each one of them. So whichever one of those appeals the most to you, consider going that direction. Then you have the idea, are you a more aggressive investor or more conservative? You're on the more aggressive side. The stocks under 10 strategy, the small cap strategy, the growth strategy, and the technology strategy. Those would be the ones most aligned with being an aggressive type of investor. Therefore, on the other hand, if you know that you're a little more conservative, you want to sleep a little better at night, right? A little more lower beta, right? Lower volatility, large cap, safest, and income strategies make the most sense. And yes, the stocks to short strategy, something for every market environment. And indeed, I'll show you in a few slides here that, yeah, that strategy has been a big winner this year. Obviously, the biggest winner of our strategies, given the rough market environment. Sometimes there is good reason that that's about the only strategy to consider. It sure as hell would have been in 2008 and early 2009, right? So that's one in the know thyself. Now, the bullishness rating, okay? Help with market timing trades, because the more bullish you feel about the market outlook, the more aggressive the strategies you should be leaning into, right? And the higher the likely return. And then obviously vice versa. In a bearish environment, you would get more conservative. So on the home page of this service, by the way, it's called Power Screens 10, and it's just so you know what we're heading here. I'm going to show you how to get access to this in about 5-10 minutes. So yeah, you could dial into any of the strategies. Here's the performance, but this bullishness rating that we put in here, the more bullish you're feeling, going for the most aggressive strategies. You'll see here, this 10, you'll see how the all-time, it's aligned with the most highest performing strategies, because in rougher environments, it may not do as well. There at the other end, the more bearish you're feeling, right? So the bullishness rating of 1, the stocks to short would be the best choice. By the way, that 25% return for all time, the market was up on average 8%, 7.98% in the time period that this portfolio is up 25%. So even during the best of times, it is pointing out stocks that are straight up poison. So definitely make sure they're not in your portfolio. But if you are that kind of trader, you feel confident shorting stocks, this is the right basket to pull from. Okay, so now the last strategy. Steve, just show me the top performing stocks. We have performance details, right? So let's play. A lot of people like to cherry pick performance details. They show you a couple things to put things in their best light, but they don't put it all out there. I don't think you've ever seen a service, or I think you've rarely ever seen a service that has as in-depth performance information as we have. So this is the homepage, right? And actually, I should have cut and pasted on here that even right now, I have a year-to-date for 2022, and I also have the February. So we're updating it every month, but we're going to continue to highlight the performance information on the homepage that gives you a general picture of where things are, okay? But then for each individual strategy, we're going to have a page that has the full details, right? So here we are for the performance numbers for the top 10 strategies. This was taken as of the end of the year, but yes, right now on the website, they're updated through the end of February. I want you to see the level of detail. What's the total return, the annualized return, year to date, month to date, 4-week, 13-week, 1 year, 3 year, the monthly performance going back the past year. How's it doing versus the benchmark, which is the S&P 500? How's the performance by calendar year? The reason, by the way, notice it's outperformed, this strategy is outperformed the S&P 500 21 of 22 years, okay? Only one time underperformed. That's consistent, and of the 5 times in recent history that the S&P 500 has created a negative return, it has actually produced a positive return. That's, and by the way, there's even more information beyond this. I just want to try and show you the depth of information, because the last thing we want to do is we understand the statement, past performance is not a guarantee of future results. To get into the depth of this information increases the confidence that it's not a fluke. Oh, it's not like it had 3 or 4 glorious years and the rest stunk, right? And then those amazing years make up for the others. No, it's to see the consistency of the years, right? So the top 10 growth stocks, we have this for all the other strategies too. Now, as I said, I can imagine some of you folks, okay, Steve, you showed us some numbers based upon time periods where the stock market was basically bullish. Okay, that's terrific. How is it doing this year? So let's get into that. So as a backdrop, all these numbers are as of the end of day Friday, because I did this over the weekend. S&P 500 down 11%. The Cathie Wood ARK Innovation Fund, right? A lot of the sexiest stocks that we love to talk about, that's down 41%. And as John said, I think he said that over 25% of the stocks in the market are down 50% or more, right? So there's a lot of stocks in bear market territory, and the S&P 500 sometimes is not the best way to look at things because it's a lot of the more conservative stocks. So I think you get the idea that the environment has been brutal. 7 of our 10 strategies have beaten the S&P 500. And yes, all the strategies have beaten Cathie Wood's ARK Innovation Fund. So 7 of 10 strategies have beaten the S&P 500. Even some of the most aggressive strategies have done that. 3 of the strategies year to date, and by the way, these numbers are through March the 15th. I updated all the performance studies through the middle of the month. No, sorry, not March. Today's March the 15th, through Friday, which was the 11th, okay? 3 of the 10 strategies are in positive territory. The large caps plus 0.81%. Not that that's so phenomenal, but when the large cap index is down 11.5%, that's pretty darn good. The stocks under 10 strategy was up 4.23%. This is the most shocking one because it's actually one of the most aggressive strategies, the one with the best all-time performance, and yet in this atrocious environment is actually producing positive returns. And yes, the stocks to short strategy is down, it has gained 15%, not a surprise in this environment. So I ask you, do you want to see all 10 of these strategies? Do you want to dive into the proof of performance and see that depth of information to feel confident in the decisions you're making? And altogether, do you want to see the 100 best stocks on the market today updated daily, right? So if you do, and that's what our Power Screens 10 service is about, right? It includes 10 market-beating black box strategies that we talked about, 10 stocks each updated daily, complete performance data, bullish and bearish strategies, something for every market environment, a weekly email from me. And this is not like a newsletter. This is just kind of like dialing into updates in the performance studies, little tips that will put you in the right direction of what's being successful right now. Just little reminders of how to make best use of the service. But when you put it all together, everything you need to beat the market in every market environment. So for as great as all that is, there is a little bit of an issue here, okay? And then I want to spell it out here. The data scientists who created the project, who created the power ratings, and we went back to and we said we want to create these 10 strategies, he hated this project. He didn't want to do it, plain and simple. And that's because he actively trades in these ratings. He spent 5 years testing every parameter you can imagine on the planet to find 118 of them, right? So he tested thousands of parameters, 118 of them ended up in the power ratings, meaning we scan every stock by 118 different factors. Each one of those factors leads to outperformance. He spent 5 years of his life creating the model. We then went to him and asked for a customized version of it, which is about 98% the same as what he has. It's a little bit tweaked to be a little bit more on the active trading scale, not as long-term as what he had, right? To be really good in that 1 to 3 month time horizon. He actively trades on these ratings and didn't want too many investors come in because, as we talked about, if you have too many investors in a strategy, it leads to weaker results, right? But I'm not a guy who takes no very easily. I'm like, okay, I hear what you're saying. There's got to be a way that we can bring this concept to life to create these 10 strategies, but do in a way that you feel comfortable that you could still trade these things successfully. So, 1, can never divulge the parameters. Easy. That's why we went the black box route. That was an easy one to agree to. No trials, right? Because a lot of people just kick the tires on products. Let me just take a look at it, and they're getting access to it without paying for it. No, this service is just too valuable for that. So no trials. Okay, I easily agree to. Limit the number of subscribers. Okay, and we had some debate on that. All right, he was much more conservative in that camp. He wanted a lot fewer folks in than me, but in the end, he was the one holding the card. So I had to agree to those parameters. So what we do is we're just letting people in bit by bit. We started in January. We've opened it up once again in February, and now we're doing it once again. So what we're going to do here is we're going to open up 75 spots, right? So yes, there's the people on the webinar today, but also we're going to take this video, we're going to share it with our entire audience at StockNews. We have 98,000 people on our email newsletter list. These 75 spots will go fairly quickly, but you guys are hearing the message first, right? So the first 75 subscribers is when we will cut it off, or we'll let it go through Sunday night, March 20th, whichever comes first. All right, so now, the drum roll and the price, right? Most of the services, and I can say this with supreme confidence because I had one like this when I was at Zacks.com. Okay, most of the products that are similar to this are about $2,000 to $5,000 per year. But what we're going to do, in particular because of the market environment, we're going to say we'll go as low as $97 per month, right? Which I think most of you guys would be willing to pay for just one of those 10 strategies. When you take a look at the performance, you take a look at the consistency of the results, $97 per month would be very legitimate for that. but to have all 10 at your disposal, right? And to have it there for every different market environment. So stocknews.com/MH10, right? Like as in Mad Hedge 10, right? So you can go there now, you can start getting the order. Even as we're talking here, you can open up another tab. You'll still be able to hear me on the webinar, right? But I'm gonna also show you, you can absolutely go the $97 per month route. But the thing is, we put on 2 more offers on there if you want to take a little better advantage, a little better pricing. We can go $997 for a year, which is like a 16% savings. So that's a little bit better, right? Because $97 per month is roughly $1,200 per year. So we can do $997. But the best one, and the 2 previous times in which we've had this webinar, 85 or 90% of the customers went for this, right? Because of the tremendous savings over the monthly. $17.97 for 3 years. That's less than $50 per month, 48% savings over the monthly, right? But let me tell you why folks were so confident in that. Because there is no trial, and because we're talking about going on as far as 3 years, I'm going to give you a 90-day refund period, right? So any questions asked, because in particular, I don't want folks to make judgments too early because the market environment's terrible. I want you to see this over the right amount of time that you can feel confident this is going to help me be more successful. On top of that, we're going to give you a performance guarantee. So beyond the 90-day refund period, right, which is any questions asked, performance guarantee. The language for that is on the website, on the stocknews.com/MH10. Performance guarantee, the layman's version of that, if we can't help you beat the market, we don't deserve your money. Plain and simple. That's what it comes down to. So we don't help you beat the S&P 500, you get your money back on the subscription to the service. That's why people feel so confident stepping out to the 3 years, because they get to enjoy the 48% savings, but they also get to enjoy the 90-day full refund period and the performance guarantee to give them great confidence to try it out. And by the way, I'm also putting up there the phone number in case you want to talk to one of our folks. If you had a little more questions about how this works and things of that nature, but this is how to get started. As low as $97 per month if you just want to get started and see what it's like. But I highly recommend the $17.97 for 3 years to lock in that savings and to have those performance, the 90-day refund, the performance guarantee behind you. So I'm gonna leave it there. People can start ordering while while we're on the call here. And I was hoping that one of the folks from the Mad Hedge would take a look at the questions and start firing them away to me.
Sure, I can feed you questions, Steve.
Yeah, I appreciate that.
Let's see. Let's see what questions are here. There's a question sort of about Kathy Wood's practices.
Okay.
But it's super big. Yeah, I guess, can you talk about like the Kathy Wood's approach versus yours?
I'm a value investor, right? So even though I have the power ratings at my back and it's looking at 118 factors and it's aligning me for things, I just can't chase growth stocks. So there are times that Kathy Wood's approach, when the market has a higher risk appetite, when they are willing to pay anything for growth stocks, and I'm just more about value or growth at a reasonable price. So that's a great difference. There's times when her strategy is the cat's pajamas, but I'm a decent fan of mine over time. And here again, take a look at the performance of what she's doing right now. If you can stomach a 40% loss when the S&P is down 11%, you're a better person than me. That's just not acceptable to me. And I just think there's better ways in which to go about the market. Having tools like the Power Screens 10, where 7 of 10 of those strategies have beaten the S&P 500, that's a superior approach, in my opinion. By the way, and I got to say this out loud, my company was recently purchased by a group called Financial Answers. Financial Answers on the board is Kathy Wood. So I don't want to demean her too much because she is a board member of the company that recently purchased StockNews. So So I'll just leave it there. We got any other questions? By the way, folks are starting to order. I can see, yeah, most people are going for the 1797, but yeah, there's a couple 97s in there, whatever you're comfortable with, right? And yes, you can come back later and upgrade if you want, but it's one of those things. You might just lock in the best price. One of the reasons why I created my own firm, StockNews.com, is I wanted to do things my way, and it's a golden rule kind of thing. I get really ticked off when folks make it hard to refund or won't give me back my money when it's rightfully due me. They make you jump through hoops and run through circles and all those kind of things. That's just not the way it's going to be. If you're not satisfied, I don't want your money, plain and simple. So that's why it's better to go with the 3-year approach. And that's why 85, 90% of folks normally go that route, just because they have those ironclad refund guarantees at their back. What else we got? What other questions?
Not seeing any other questions now, but you could run through maybe some frequently asked questions you get with the services.
Yeah, I think when it comes to the power ratings, okay, when we take a look at the way the market works right now, even some of the famed money managers who come on CNBC, whether they're hedge funds or they're they work at Fidelity or American funds or whatever, we think of these folks as these stock picking rock stars. That's a thing from the long past. These guys just don't sit there picking stocks. They have computer-based models. They have a team of people who have created models, who vet out the stocks. And in the end, there may be a little bit of hand picking, but most of it is computer driven. And that's because quant models, computer-based models have stood up better than people. You probably have heard that 85% of mutual funds underperform the S&P 500. 85%. Okay, that's kind of a woeful underperformance, right? So here again, because that historically this idea of handpicking stock selection just doesn't work as much. So this is why over 50% of the trades in the stock market on any given day are computer-based. This is why I strongly lean into that. And here again, think about where I came from. I came from Zacks Investment Research, where they had the Zacks rank, which is a quantitative model, or good peers in the industry, Value Line, and how they've had a quantitative model, or Investors Business Daily, their CanSlim model. These are computer-based quantitative models that have stood the test of time, that lean people in the right direction. What I will say to the benefit of the power ratings is I know of no model available to the public that covers as many aspects, 118 different factors, everything from growth to value to momentum to sentiment, right, to the fundamentals, to the price action of momentum. All those things are considered in those 118 factors. That's about as good of a DNA check on a stock and its future potential, and why I think it is so consistently picks winners. So that's the overall power ratings. Then when you drill it down to strategies, something for every market environment, right? Whether you're bullish or bearish at the time, whether you're a growth, value, income, or momentum oriented investor, there's something there for everybody. Into having at that moment those 10 best stocks in that category at your disposal, that's what you get in this system here. And starting from that goodness, that fountain of goodness that was the power ratings. That's what I think that most people need to know at this time. And by the way, we launched this product in January. It was the biggest product launch that we've had in our 3-year history, literally 5 times larger than any other product launch we had. And so normally with any product, there's going to be refunds that come in. That always happens, rain or shine, because people are not sure of it. And typically refunds run in the 20 to 25% category. Right now on this service, we're maybe at about 5% refunds, okay? And I think that's a statement of people came in at the worst possible time, and yet they found strategies. 7 to 10 strategies have outperformed the stock market, 3 of them producing positive results this year. I think when you appreciate that this stock has helped you through the worst of times, that when the getting is good and the bull market's running, how much happier you'll be that you'll have this thing at your disposal.
Awesome.
So
we actually have we had a couple of questions come in. Sorry, I
cool.
didn't cut you off. As a value investor, what do you think of the opportunities presented in emerging markets, which have experienced comparable declines to the 2016 and the 2020 drops?
Yeah. The emerging markets is such a feast and famine market, right? And so what happens is that we forget about it as a group of investors. Then we see it rallies 30, 40% in a year. And then we're like, oh, I want to get in. And that's exactly like buying at the peak and it comes down. So therefore, what it's saying is when it's a little roughed up, that's a pretty good time to get into it. Now, what I can tell you is that there's another break here. So it's now a good time to get into emerging markets. And I would say yes. I wouldn't necessarily overweight it, but I would have a healthy allocation to it. But you know, thanks to the government and all their tax policies, right? So I got all these different pockets of money, IRA money and joint accounts and money for my kids and all that kind of stuff. And in a number of the accounts, I just don't want to be trading stocks in each one of them. So I basically have a very simple approach. I own 5 ETFs to keep the cost really low, right? So, you know, SPY is in there and IWM for the Russell. But I buy EEM. So I want like a 10% allocation to emerging markets, come rain, come shine. And EEM is just a really easy way in which to allocate towards that. So for those who just want to kind of set it and forget it, then I would just go the EEM route.
Awesome. Another question from BJ. He had the previous question as well.
Yeah.
Regarding the charts comparing stocks to bonds, some think that is not correct to compare stocks with an extremely overvalued bond market. What are your thoughts on that?
Okay. So if bonds are extremely overvalued, which is true, right? Because we have a historically low rates, okay, then that means that new investors will not want to put money into the bond market because their value go lower. So where do they go? Do they go to cash? No, cash is trash. So therefore the stock market is the best alternative. So I'm agreeing with you, and yet still that's kind of proof positive of why the stock market is the best place to be. That is not going to last forever. When they come back into parity, which I believe will be somewhere in the 3.5% to 4% range, like that's the 10-year treasury, like 3.5%, 4%, the earnings yield kind of moving that direction. That's when stocks on a PE basis, on a price to sale basis, on a price to book basis are going to be near all-time highs. That's going to be a time to start heading for the hills, okay? Because then stocks, but that is likely 18 to 24 months from now. So I keep riding this bull until there's a reason not to.
Awesome. And that's all we've got for questions now. Oops, we've got, yeah. BJ's just saying thank you.
Yeah, cool. So listen, folks, just real quick. Make sure you write down the URL because it's going to come off the screen here in a second, or the phone number, right? So stocknews.com/MH10. Take advantage of the offer here. Again, we're only going to have this open for the next 75 people. And here again, we're going to do marketing of this replay. I think it's starting tomorrow to the 98,000 people in our email database. And so take your spot while you got the opportunity to. And I think you'll be very happy in that decision. And if you're not, for any reason, it just doesn't feel like it's a good fit for you, 90-day full refund. And then, of course, the performance guarantee on top of that. All right.
Awesome. Thanks so much, Steve. I know we're going to have John on here in a minute to announce.
I'm here. I'm just listening in to all the questions. Okay, Steve, thank you very much for educating our audience, as you always do, and look forward to having you back in the next summit in June.
Sounds great. Always look forward to it. All right. Take care, John. Take care, folks.
Okay, you take care.